Ian J. Capital here, your mother's favorite friend of the family. Talking about this glitch that happened in Robinhood. And Robinhood tends to have these glitches. So the user was a guy from Reddit. Reddit's a social media platform, and there's communities in which you talk about certain topics, and they're called subreddits. So this subreddit is called Wall Street Bets, and they're known for, taking crazy bets in the stock market. So there's this guy who he found a little loophole. So he started with a certain amount of money, let's say $2,000. When you sign up for margin is when you borrow your broker's money. They give you 2 to 1. So if you have 2,000, they'll give you 2,000, and your new portfolio will be worth $4,000. So he found that loophole where if you use your margin and if you sell covered calls is when you own 100 shares of a stock, you sell it and you collect a premium. When you sell covered calls, you get the credit immediately. Once you sell it to the market, you receive the credit. So he kept doing this. He kept kind of rinse and repeat, where he would buy 100 shares, sell a deep in the money covered call, and keep doing that because Robinhood kept giving him essentially a loan, and he kept doing it. As his portfolio grew, his loans got larger. So he has his face in the little bubble. These are contracts for Apple. They're Apple puts. So a few things right off the bat. It's 9:29. So this is his reaction a minute before the market opens. And he was up $6,986 the day before at close. He should have closed it out, but what happens is you get greedy and he's going to pay for it. This is money on margin. So this isn't his money. This isn't money that he could just spend and be like, okay, if I lose it, I lose it. This is somebody else's money. This is his broker's money. And when you're borrowing money from your broker, it's not like you're borrowing money from your friend who you could skip town on. They know your social security. They know everything about you. So, just a few things. I'm going to pause it. He has 358 contracts. The value is $57,684. He was up the day before at close, and he bought. The size wasn't the problem. Even though it wasn't his money, the size wasn't the problem. It was that he bought next day contracts that expire. Because A, he doesn't know if the earnings are going to be good or bad. He doesn't have inside information. And B, if they expire the next day, it's not like buying shares in a stock. When you buy shares in a stock, if you buy shares of Apple, $57,000 worth of Apple shares, you won't lose $57,000 ever. Because for you to lose $57,000 on shares, it would have to go to zero. With shares, it's rare that it goes to zero. But with option contracts, it goes to zero all the time. So he bought next day expirations. It's about to be 9:30. Be patient. Boom. It's 9:30. You heard that sound he made. He's down $40,000 right off the bat. He went from being up $6,000 to being down $40,000. So a few things. Number one, a few things you can learn from that. Number one, if you're buying options, remember they're a depreciating asset. After that expiration date, they're not worth anything. There's 3 things that can happen. 1, you make a profit off your contracts. After the contract goes up, you sell your contract, you make a profit. 2, you exercise those contracts, which means if you bought one call of a $58 strike, you would buy 100 shares at $58. Or 3, the contract expires worthless and you make nothing. You lose everything. So he's in that boat because the contract expired that same day. So the time decay is moving so fast that he's losing money as long as he's holding it. So his best bet was just to close it. Don't play earnings plays. You don't know what's going on the inside. Just because you move boxes at Amazon doesn't mean you know what's going on with Jeff Bezos and them. Number 2, if you're buying next day expirations, understand the risk. It went his way, he could have made millions, but the risk outweighs the reward on that. Number 3, if you're buying contracts, even if it costs more to buy out further in expiration, do it. It lowers your risk. And the thing I'm not going to beat the guy when he's down. It's a stupid trade, but we all made stupid trades. This guy got greedy. He's using somebody else's money, and he paid for it. It's a depressing topic when people lose money, so we're not going to beat on him. But if something seems too good to be true, it usually is. I know that. Listen, Robinhood has a history of allowing people to go crazy with margin. I think that earlier this year, and this guy, he became famous on Wall Street Bets, where he was buying box spreads. So a box spread is when you buy a call, buy a put, sell a call, and sell a put, all on the same stock. Same expiration, same strike. Essentially a delta neutral strategy. So you don't really care if the stock goes down, because your puts and your selling calls will offset the losses on the other side. Alright, box spreads. So he had this box spread, right? So think of it like a table. You got 4 legs on a table, and what happens when you take one of those legs out? It's wobbly. When you're doing a box spread, he was assuming it was going to be delta neutral, where if he holds on to this, I think it was 2 years away when they expire. So he had some time left. What happened was, because we're in America and he was trading American style contracts, he got assigned early. So what happens when you're assigned early is you have to make up for those shares that somebody else wanted to buy. This analogy of a table is somebody took one of the legs out. So now he's leaning towards one side. And I forgot where the market was at the time, but the side that it was leaning towards was not in his favor. So he was in the red. And Robinhood found out about what was going on, and because it's their money, their money's at risk, they completely closed out all his positions, and he was left with a $50,000 loss. So he had to sell early. Now it was Robinhood's fault that he had to sell early, but it wasn't really, because it was their money at risk. Stop looking over there, kid. For European style options, whatever the expiration date is the only time you can buy and sell. Yeah, so I don't know what's going on with that guy right now. He might be in a lawsuit right now. So today, that's our video on why Robinhood is no good. Robinhood is no bueno. Yeah, like what he said.
What did I say?
I don't remember. I wasn't listening, honestly. If you come in with a lot of money, right? If it's your own money, do what you want. Who cares? We're not going to stop you. If you're borrowing somebody else's money, the broker's money, they're going to need it back. They're going to margin call you, where they're going to force you to either sell what you have or deposit money to meet that margin requirement, or they're going to take you to court. Screw it.